Hello, everyone. Welcome back to, I'm sure, all of your favorite Talk Real Estate Tuesday. It is episode 13 already. I'm Ashley Nate, and I come on live every Tuesday from my page here to talk about relevant and hopefully informative real estate information for you. So, what we're going to do today is kind of continue off of what I started last week. So, last week I said we were going to kind of switch gears and start talking about some things on the investing side. So, my husband and I own some different types of rental properties and real estate investments. So, I thought it would be helpful to kind of share some of our personal experience and just kind of some information on how to invest in real estate, different options, and how to get it done and how it could be possible for you. So, last week we talked about how to analyze a long-term rental. And so what we're going to talk about today, say you went online, you found a long-term rental, you analyzed it, it looks great. It's going to make some major cash flow for you, major appreciation also. And you're like, cool, well, how am I supposed to buy this now? Well, that's what we're going to talk about today. We're going to talk about 5 different options that are out there for getting down payment funds to buy your first investment property. Okay, so I'm going to do my best just to kind of briefly cover each one of them, but not really go into a lot of detail on each, just give you the nuts and bolts. And if you have questions about any of these, you're welcome to reach out to me or reach out to your lender. And obviously keep in mind, like, I am not a financial advisor. I am just simply sharing information from my own personal experience, my own opinions, and just giving you some ideas of what's out there. And then obviously you can do your own due diligence to see what makes sense for you. And with each of these options, depending on the property and what your intentions are with the property, certain ones of these options might make more sense than others. So there's lots of moving parts. Long story short, as I'm sure it goes without saying, do your own due diligence in terms of if one of these sounds like it could be an option for you, determining if it makes sense, and speaking in more depth with a lender, financial advisor, whatever. Okay. All right. So the first one that I'm going to talk about, and these first 2 options actually only have to do with if you currently own a primary residence. So if you don't own a primary residence, you'll be able to fast forward this a little bit. But if you do own a house currently, these are options that you can use. And I'm speaking to these first because this is exactly what we did to purchase our first investment property. So the first option is called a cash out refinance. So what that basically means is if you have equity in your primary residence, what you can do is you can cash out a portion of that equity and refinance the loan into a higher amount, and then use that cash on a down payment to an investment property. That's exactly what we did. That's how we bought our first 5-plex. We held off on investing in real estate for years because we thought, well, we don't know how we're going to do it. One day we saw a 5-plex. We thought, this seems like it could be a good scenario for us. Didn't know how we were going to buy it. Went and looked for it, and looked at it, liked it, talked to our bank, and they told us about this option. So that's why I always preach, don't count things out until you dig a little deeper. But long story short, that's what we did. So if I show you a quick example here of what that might look like, got my whiteboard here. Say that you own a house right now and your house is worth, the market value is $300,000. So a lot of times with the cash out refinance, you can refinance up to 80% of the value. Sometimes you can go higher, but I probably wouldn't suggest that, just because then you're going to start getting into having to pay PMI. And I think there's some extra fees and there's just more risk with that. So you can often kind of shoot for up to 80%, which you don't even have to do that whole amount either, but that's just kind of your limit. So 80% of this would be $240,000. So you could refinance up to that amount. That's your kind of your max. So let's say then that you have a mortgage on it, and on your mortgage right now, you only have $100,000 left. Okay, so this amount here between these two, the 80% and the amount you have on your mortgage, is how much that you could potentially take out in a cash out refinance and then refinance up to that larger amount. So you kind of have $140,000 to play with. Maybe you didn't want to do all of that much. And in today's climate, this option might not be really something that many people considered given interest rates. When we did it, we refinanced from a higher rate to a lower rate. So I think our mortgage payment actually ended up being the same, even though we took some of that money out. That might not be the case right now. So obviously that's where you want to do some more digging, and this is an option. Is it the best option right now? Maybe, maybe not. And that would all depend on the numbers. I mean, keep in mind, even if it was a higher interest rate, if you're using that money to buy a property that was cash flowing a lot, even if it was a higher interest rate, maybe it still makes sense. Just lots of things to think about, but that is how that works. So basically, you would refinance to a higher amount, get that cash, and then use that cash on really whatever you want, but probably use it on something smart like an investment property. Okay. Second option, this option is also for a primary residence. If you own a primary residence, rather than doing a cash out refinance like that, what you could do is you could take out what's called a home equity line of credit. And that is basically a second mortgage. So you would have payments on that separately from your main primary mortgage. And the nice thing with that is similar that you could borrow up to 80% of the value. Again, I think you could go higher, but I kind of stick with that 80 number. So you could still have that 140,000 to play with, but you're not taking it out all at once. What you're doing when you're opening up a HELOC is it's a home equity line of credit. You're having this line of credit available to you that you can pull from if you want to. So you don't have to take that whole amount out. Say you set that up. It's almost kind of like a big, think of it as working similar-ish to a credit card, with your house as obviously the collateral, lower interest rates and all that. But it works similar to that. So you only take out what you want to take out, and then you make payments on that. The more you take out, obviously, the higher those payments are going to be. Once you pay it back, your balance is back down at zero again. So it kind of works in that fluctuating way, the way that a line of credit would. So keep in mind, kind of looking at the things I want to make sure I told you, keep in mind with that option. However, if you are going to use a HELOC as your down payment, that counts as part of your debt to income ratio for a lender. So that might lower the amount of investment property that you can afford. It's going to have an impact on the price that you're able to purchase, because it's going to affect what that debt to income ratio is, because that's new debt that you would be taking out in order to pay for the down payment. So again, something to think about. That's an option, and maybe it's not for the down payment. What we did with a HELOC on our house, again, sharing kind of my own personal experience. I'm not just like riddling these off because I Googled them. I've actually done these things. You can use that for like a renovation. So maybe you don't use the HELOC for the down payment, but you buy something that is distressed, and then you use a HELOC for the renovation. And then after you do the renovation, what you could do is do a cash out refinance on that property and pay off the HELOC with that money. So that's kind of probably getting a little bit out there. That's known as the BRRRR method. Maybe we can cover that later, and that's what we did. But just throwing that out there. Okay, so those are the two big ones. Those are the ones I'll spend the most time on, because I just wanted to elaborate on those if you own a primary residence, and especially since I've done those myself, obviously I have the most to say about those two. A third option that you can do is you can borrow against your 401k. This is something, we have actually done this option too, because when we bought our cabin in Georgia, what we did is we did that for the down payment, and then after it closed, we took out a HELOC to pay for the down payment, because of that debt to income ratio factor. Probably getting way too high level than I intended to go. But the important things to remember with this, first of all, it's going to obviously operate different depending on your individual 401k. So you'd want to talk to whoever is the one that is managing that to find out what the options are. There's also typically a time limit on how quickly that you have to put that money back in order to avoid a penalty. So for that, you want to have some sort of plan in place as to, okay, if you're going to do that to borrow that money for the down payment, how are you going going to pay that down payment money back. That 401k, put that money back. So kind of having some foresight to how you're going to do that. With us, we used a HELOC to pay that back. With you, maybe that's a really cash flowing property and you know you're going to be able to pay it off well. Or maybe you're going to do a renovation, you're going to cash money out and pay it off that way. But just having that idea of how you're going to pay it off in the future. So I kind of see it more as a short term option, not something that you want long term. So, and the final two is both hard money and private money. So hard money would be borrowing money from someone who is licensed, but not a bank or a credit union. So hard money lenders are going to use that real estate as collateral, and they're going to charge a higher interest rate than going to a traditional bank. So if you're going out to borrow those funds, you're going to from a hard money lender, you're going to expect a higher interest rate than you would typically get. And I imagine, if a lender's listening, you could correct me if I'm wrong, but I imagine that doing that would also impact your debt to income ratio, because that's debt. If you're borrowing for the down payment, that's going to affect the amount of debt that you have. So hard money, and then private money would be similar, where you're borrowing, but you're not borrowing from somebody licensed like hard money would be. You're borrowing from a friend, a family member, or just somebody that you know. And the nice thing with that, that's just kind of like someone that's willing to loan you the money. You can set up your own terms for that, which would be the nice thing. So a lot of people probably are going to charge a higher interest rate than you would be able to get at a bank, but maybe not. Maybe you have a family member who's willing to lend you the money, and then you pay them back at minimal interest. So that's kind of really the last option, is private money from friends and family. So our options are cash out refinance, a HELOC, borrow against your 401k, hard money lenders, private money lenders, and then obviously saving up on your own to prepare for that is always an option too, saving up some money on your own. But sometimes it does make sense to leverage debt in order to get into something that's going to pay you forever. So the last thing that I want to bring up, bonus option here, is the final thing, option that you could do, depending on where you're at in life and what you're willing to take on, is there is another option where you could put down 3.5% for purchasing a property that's 1 to 4 units with an FHA loan. So if you were willing to get an FHA loan, you could put down 3.5%, and a lot of that 3.5% could even be paid for with available grants out there. But you can put that down. The thing with the FHA loan is you have to live in the property for a minimum of a year. So that's where it depends on where you're at in life and what you're willing to take on. But something I wish that I would have done when I was younger is that I wish that we would have bought a house with an FHA loan for 3.5%, live in it for a year, and then you can go out and do that again. So if you're somebody younger and maybe you don't have a bunch of little kids running around that you want to, move constantly, that's just something to think about. So anyways, per usual, I'm like, I'm going to go through all of these just real quick, like in 6 minutes. And here we are, it's 13 minutes, but hopefully this information was really helpful and useful for you. If you have any questions about anything that I brought up, I'm an open book. Feel free to reach out to me. If you need a lender referral, let me know. I can get you off one of those as well. And I hope this opened your eyes to some possibilities in the real estate world, and that investing can be a possibility for you if you start asking questions and take the steps to make it happen. So with that being said, almost lost my computer there. Hope you guys have a good rest of your week, and I will see you next Tuesday. Bye.